Hello. In this video, I will be explaining how to do a times interest earned problem that you might come across in your Accounting 2 class. Let's get started. Sprout Company reported the following on the company's income statement in 2 recent years. Current year interest expense, $334,000. Current year income before tax expense, $4,442,200. Prior year interest expense, $367,400. Prior year income before tax expense, $4,482,280. So, how do you determine the times interest earned ratio for the current year and the prior year, rounding to one decimal place? First, you need the formula, which is income before income tax plus interest expense divided by interest expense. Basically, this ratio computes the number of times interest payments could be paid out of current period earnings. Because interest payments reduce income tax expense, the ratio is computed using income before tax. So, for the current year, you would do $4,442,200 plus $334,000 divided by $334,000, which gives you 14.3 for the times interest earned ratio for the current year. For the prior year, you would do $4,482,280 plus $367,400 divided by $367,400, which comes out to 13.2 for the times interest earned ratio for the prior year. From this, we can gather that the times interest earned ratio is improving from year to year, which is very good. Now, you should be able to figure out times interest earned quickly and easily. I hope this video explained everything you needed to know. Thank you all for watching, and have a wonderful day.